Welcome to HighTower Naples quarterly video market and economic commentary. This is Mark Masterson, and I'm excited to walk you through what took place in the capital markets over the last 3 months, how they impacted clients' investments, and also highlight what we see as opportunities moving forward. So let's get started. We begin where we always do, with our four horsemen. And we highlight some of our views across the fundamentals, technical analysis, sentiment, and policy. And frankly, not much has changed since our last commentary. As you can see, regarding fundamentals, we remain bullish. And our thinking there is not so much that growth is great today, because it's not, and we'll talk about that in a moment. But more, we believe that change is coming and that some catalysts for growth are in motion. And we believe that we also have a pretty low bar to beat in terms of GDP. So we believe that growth is going to improve, and that's the basis for our more positive, bullish outlook there. The technical picture also remains bullish. Nothing has changed. I'm going to spend quite a bit of time on this commentary looking at equity markets and kind of outline that for you. Sentiment, we're neutral. The reason we're neutral is because the sentiment signals are pretty mixed today. There's a lot of neutrality in terms of equity market sentiment, where investors just don't know whether they want to lean bullish or bearish and put their fingers up in the air, kind of see which way the wind's blowing. So they're neutral there. Bond sentiment certainly was negative. That seems to be improving as the bond market rallies a little bit. Gold seems to be a bit over bullish at the moment. That will correct likely in the coming weeks. And oil certainly was way too positive, and that has reversed as well with the correction. And finally, regarding policy, again, this hasn't changed. We're neutral because monetary policy remains supportive broadly globally, yet we do believe that the Fed tightening is the right thing to do, but they better keep an eye on growth. So if they tighten too much, that could end up being a headwind to growth. We need to monitor that. Likewise, we believe, as we mentioned earlier, that the fiscal policy has the potential to emerge as a catalyst in a positive way. So we're going to stay neutral, a little bit mixed with some positive and negatives there. But broadly, the four horsemen haven't changed too much in terms of how they're informing our allocation decisions. Let's take a quick look at Trump's first 100 days and a little report card as to the pledges that he made. As you know, we believe that there are some changes underway that are going to help the economy go from a QE towards a fiscal policy-driven deflation, slow growth to inflationary higher growth, lower rates to higher rates over time with the change in equity market leadership. If you look at the report card, we're seeing a stalling here on one of the pledges to repeal and replace Obamacare. That's the vote was taken off the table, of course, so we got a setback there on that side. Not sure how that's going to play out. There's some talk that there may be another vote coming, so we'll have to see how that plays out. The regulation rollback certainly is ongoing, and the pipeline and energy infrastructure projects certainly are ongoing via executive order. And frankly, this is the item that has to get done. With the lack of action on the Obamacare situation, tax cuts and tax overhaul has taken center stage as the centerpiece. It's a must-win as far as we're concerned. So that's what we're keeping our eyes on, and that's what's likely to take center stage from the Trump team over the coming months as we move through the second quarter. But markets certainly responded to, despite some negative press and news and such, markets certainly responded in the first quarter positively to the beginning of the agenda unfolding and the potential that it delivers for growth. If we look at the macro in the fundamental view, this doesn't look too great at the moment, but again, it leads to our view of a low bar. Even the Fed has now dropped their first quarter growth estimate to 1.3%. That's probably going to be right, 1 to 1.5%. It's not impacting optimism. Small business optimism is on the rise, as you can see here. Consumer confidence is on the rise. So it's a pretty low bar, and we believe that the potential to go from 2% GDP or even sub 2% GDP to 3% is a real opportunity. Central bank policy hasn't changed all that much either. What we're seeing is you see the Bank of Japan, which is the pink color, ramping up their balance sheet. They're doing QE. The ECB in blue is doing QE, and the Fed is not. The Fed has stopped doing QE. They're not shrinking their balance sheet, which simply means that they're reinvesting their bonds, which is a form of QE. But certainly we're seeing kind of a bifurcated central bank policy where the Fed is tightening, other central banks are easing, and that's something we've got to watch and monitor going forward to make sure that the Fed doesn't become a headwind with the stronger dollar. And we'll talk about that as well in just a little bit. This is where we're going to spend quite a bit of time, just taking a look at asset classes, investments, particularly in the equity markets. So if we jump right in, the equity markets have really had a good run so far. Here's the election. We had a number of down days ahead of the election. Everybody was negative. Trump wins. The expectation was markets were going to really struggle, and yet we saw a burst higher. Then we see this sideways consolidation, then another burst higher, and now we're in another sideways consolidation. So, we're kind of seeing fits and spurts there, but it really looks good technically. And I highlight that with this blue line, which is the kind of the support that we're seeing for the S&P. It all looks pretty good. We were oversold. We're now moving higher. We were overbought, and this sideways consolidation is working off this overbought. So technically, the market looks fine here. The bigger picture also looks good. This is the 7-year bull market. You can see a few times it was challenged where, that lower band was tested, not broken. So, it looks pretty good as far as we're concerned. And as long as that trend remains in place, it's a good bet to continue to expect the markets to grind higher. If you look at the historical data, and this is some of the points I'm emphasizing with clients in meetings, history really is looking pretty positive for the equity markets this year. I'm just going to point out a few. So this is a study that was done by strategists, and they look at different combinations of governments. And what they found was two of the strongest equity market returns for the S&P came during Republican control. So you had this period here and this period here, similar to today where the Republicans control the government. It has been, in the past anyway, very positive for equity markets. So, for us, we put a check historically in the box for equity market performance under this current regime. The second looks at just simple performance in January. And there have been a certain amount of times, a couple of years here, as you can see, when the S&P never traded negative during the month of January, as happened in 2017. With the exception of 1987, where we had certainly a big crash in October, the other periods were quite positive. In fact, including 87, the average was 13%. And the drawdowns were really modest. So, again, another check in the box that this year has started off well, that we'll have a decent year for equity market returns. How about when January and February are both positive? Again, 27 different periods going all the way back to 1945. And of those 27 windows, 27 times were positive. Yeah, there were a couple of modestly positive years, but no negative years. A couple of really positive years, of course. But the average was pretty strong at 24%. So another check in the box for historical positive performance for equity markets thus far. And also, if you look at bull markets, we know we've been in a bull market. We know it's maturing. One of the questions is what happens at the end of bull markets. History suggests that you want to participate at the end of bull markets. If you look at prior to the peak, the 24 months prior, the 12 months prior, and the 6-month prior, just look at these numbers and the averages and the means across. There's the 2 years, here's the 12 months, and of course the 6 months prior to the peak. Again, what you end up seeing is, I dare say, kind of blow off moves, but very positive moves in the window of opportunity before a bull market ends. And some we're in that range in our view, that we're in the 24-month window now as before this bull market takes a real pause. And what could be the catalyst? I'm showing clients where the money's flowing, and it just has not been flowing into equity markets. It has recently. As you can see, there's a turning point here at the election where you're starting to see money flowing into equity markets again. But it's been very steady into the bond markets. What happens if the bond market rolls over and we see interest rates grind higher? You're going to see that money probably flow, I believe, into the equity markets, and we'll start to see maybe a catch-up where the bond market money flows out, stock market money continues to flow in, and we see a positive catalyst there. I mentioned the bull market being mature, and indeed it is. But I saw this study, and I want to just raise it to you because it's something to point out. Listen, the market is mature. the bull market is long, but what if we reset the calendar? There have been some pretty good corrections. For example, from May to October of 2011, the S&P fell almost 22%. Well, that counts technically as a bear market. What if we reset the bull market to that window? Or how about the window from 2015 until 2016? Even though the S&P only fell 15%, there were some big drops. For example, the Russell 2000 small caps were down 27%. The Nikkei was down 29%. Dow Jones Transport down 32%. Emerging markets 40%. Chinese 50%. Small cap biotech 51%. Oil 76%. So, hey, listen, sometimes it's only truly seen in hindsight. So the bull market could have really been either reset in 11 or 2015, and we could have seen a stealth bear market there. Something to consider anyway. And I've shown you this chart. This shows the secular bull markets where you see these long windows, these 15-year to 20-year windows of up and down action, but really sideways markets. And then you get a breakout. We see it here to there. What about this window here? Are we witnessing a breakout now from a long 15, 16-year consolidation? It certainly is possible, especially when you look at the NASDAQ. Here's a chart of the NASDAQ that shows the last peak back in 2000. And then we break out again 16 years later. Are we off to new highs? Yes, we're in new highs, but are we really going to take off like we saw? It's a possibility. Of course, there are some hurdles, and valuation's a big one, no doubt about it. But look, the fact remains that we finally broke out to new highs after 16 years, and that's consistent with this chart that we showed you here of these long consolidations. We are seeing a dominance in U.S. stocks. So, again, the S&P is outperforming the MSCI World. That's been a pattern. We're certainly favoring U.S. stocks, but it's one to pay attention to. We're starting to see a little catch up there in some of the global markets, and that could be a positive as well, I think. So, something to keep an eye on. And the biggest, fly in the ointment is valuation. There's a lot of different ways to view valuation. We don't favor one over another. We look at stock market cap as a percent of GDP. And you can see that, that shows that we're pretty overpriced. And I think most valuation metrics will show you the same thing. That's the biggest risk. It's just, it's getting later in the cycle in terms of valuation. But some of the other catalysts and positives that I showed you are also valid and why we're maintaining a positive bias, particularly the historical data as we move through 2017. When we look at bonds, our bond view is that the bond market will do okay this year. This is a chart that just shows the TLT ETF 20-year Treasury, and you can see it's just kind of riding the lower channel here. No breakdown, which is fine. If it breaks down, then bonds will be in trouble. But for now, it's just been a correction inside of an ongoing bull market. We do believe interest rates are going to grind higher. So that's the challenge for fixed income and what we'll be watching. But we're not ultra bearish or anything on bonds. We've just underweighting bonds. We're still going to hold them as part of our asset allocation. And we actually continue to believe that we're going to see this long drawn out bottom, similar to what you saw back here, back in the 40s before you started an interest rate cycle up. And as you can see, this is Eric Schwartz of Market Anthropology's chart, but you can see the current pattern is following it perfectly. This is the same as that. So if that's the case, we're really going to see interest rates kind of chop along here for another year or two, then likely start to move higher. And I also want to point out to clients, one of the periods where interest rates really moved a lot was in the 1970s. And in this chart, you can see when interest rates were moving higher, these were not exactly terrible returns for the 10-year Treasury. So the bond market, can be resilient even in the face of a challenging environment. And that's why we're holding on to our fixed income allocation, just underweighting and being a little more careful. That's all. And lastly, as we move on to real assets, we want to highlight, we've been focused in the precious metal space, a little bit in oil. So that's what we'll look at here. So we still believe gold will do quite well. We think that over the last 10 years, the average return has been great. All eyes are on this bear market over this 3 years. We think that was the end of the bear market. And we believe we're moving higher as inflation and growth will accelerate. We do think that in the short term here, we're going to have a few challenges. We've highlighted this in our morning roundup. This is a weekly chart of gold. And as you can see, every time we get towards the top or the overbought section, which I highlight here and here and here, it also tends to coincide with a peaking process, even if it's just for a few weeks in the gold. You can see it here. I mean, over and over and over. So we're there. We're overbought here. I just think gold's going to kind of hit some resistance and move lower for a couple of weeks. And so we've kind of lightened up a little bit, taken a little bit off the table there, and we're comfortable with that. Another sign is the miners. The miners have kind of been struggling a bit as gold has moved higher. That divergence and that difference in behavior as gold rolls over, we've lightened up on our miners a little bit, and we'll look to add to them for clients as we see this potential weakness on. Still believe that it's kind of trapped in a trading range between the lower band, and we think eventually it's going to make its way up to this upper band and kind of retest the highs. It's hard to say where we are at the moment. You can see we're kind of working our way up. So it may get trapped here and continue to bounce, but we're keeping an eye on oil at the moment. And lastly, looking at the dollar. This is kind of holds the key for us. So, we saw the dollar work its way. It was overbought. It's worked its way down to this box that we thought it would get to. It certainly got there. It got down towards our box here, and it certainly got down here as well. Now it's heading higher. We think the dollar is going to rally, and that dollar rally should help U.S. stocks, I believe. But it also may hurt gold a bit, and that's what we've got to watch moving forward. And the big picture for the dollar really is important. So you see this long-term trading range where the dollar kind of moved sideways for years here. It broke out, and everybody kind of thought that was it. We're heading a lot higher. Then it retested, and then it worked its way back in. Our view is that the dollar is actually going to head lower over time. But you're going to have fits and spurts, and we think the dollar is looking to try to head higher here in the very near future. And you look at the euro and dollar, it's just this huge gaping gap between the euro and the dollar. We think the euro and the dollar, as it did here, they tend to close the gap. You see how it closed it here, closed it here, closed it here, closed it here. And eventually the dollar is going to work its way down, and the euro is going to work its way up in time. So we're watching currencies and how they impact other investments like stocks and metals and things of that nature. So I hope that this overview and summary is helpful to you in terms of how we're thinking. You can certainly follow along every day at the morning roundup. That's where you can reach us on that slide. You can call us anytime. We're always here to help, and we greatly appreciate your trust, confidence, and look forward to hearing from you. Thank you.